Taylor. I'm joined as always by Colin G. Platt. Colin G. Platt, how are you?
Doing very well, thanks. How are you guys?
There's also somebody else, if you're watching the video, that you may see in the room with me that's not on a laptop, but is here in person. The one and only Vitalik Buterin. Vitalik, how are you, sir?
I'm good too. What a coincidence.
How about that? What a strange coincidence. So for people who live under a rock and haven't heard of your good self, just remind us briefly the Ethereum project, Vitalik, and your history from Bitcoin Magazine to there.
Sure. So I've been in the crypto space since before it was called the crypto space. Back when I first heard of Bitcoin in 2011, it was really just Bitcoin. And I found out about this thing on the internet. I started getting involved in the Bitcoin community. First as a writer, I co-founded Bitcoin Magazine, and then did a lot of development on the Bitcoin projects initially. And then about 2.5 years after that, I came up with this idea for how to make a blockchain that is more general purpose. And the ideas from that quickly turned into this new platform called Ethereum, which is what I've been working on ever since.
Excellent stuff already. And as a quick reminder as well, we've kind of come a long way in the last year. 2018 has been an interesting year. So what have you seen have been, if you were to look back over the last 12 months, what do you think have been the key insights? We've obviously gone into price correction, and I do recall you putting out tweets when we're at sort of the peak, sort of saying, we've created $1 billion in valuation and billions here and even $500 billion at one point. Have we really delivered anything? Do you think that's a natural force, and where do you think we're at in the markets?
And I think like speculative bubbles and even outside of financial context, kind of hype exceeding reality is something that's just inevitable as a matter of kind of both human mass psychology and just kind of micro incentives in terms of wanting to talk about the things that people get excited about, because that's just how you have good conversations and things like that multiplied by millions of people.
Yep.
So it's difficult to avoid having ups, and then when people realize that their ups haven't been satisfied, it's difficult to avoid the downs.
Yep.
The nice thing about the year, I think, is that the downs are, on the one hand, definitely a time of despair for some people, but at the same time, it's also a good time for the community to have a chance to kind of clean up, for a lot of real work to get done, for technology to kind of keep on quietly progressing, for people who kind of are there for the long term and understand what the space is really about, to see that the technology is continuing to progress. And I think we have seen a lot of progress on the kind of base layer technical front, and I mean, you can talk more at some point about Casper and sharding and plasma and all of those things. There's been progress on applications, and that includes both kind of the more purist sort of fully decentralized kind of consumer applications, also includes some of the enterprise stuff. There's been a lot of progress in just the ecosystem and infrastructure evolving. So I think, in general, there's quite a bit of good news beneath the surface.
That's great to hear. So, let's dive into some of that stuff, because Ethereum, as delivered, was, as we know, a proof of work chain, and that got it to where it needs to be. But there is, of course, the big question about the Casper kind of initiative and project, where you always shift it, and I think it was always a stated goal to get it to proof of stake. But there was always the questions and threats about whether or not you could do that at scale, and would that maintain. So, talk to me, again, for the layperson, what is that shift realistically? And then let's drill into some of the specifics about where we're at.
Sure. So I guess just as an introduction, proof of stake is a different kind of consensus mechanism to proof of work. So proof of work is a way in which the computers that make up the Bitcoin network and the Ethereum network and many other crypto networks kind of talk to each other and agree on what messages to process in what order. And the way proof of work, you can think of it as a kind of sort of voting mechanism where 1 unit of computing power, 1 vote. Like, that's a huge oversimplification, but it's kind of an okay way to think about it. Proof of stake replaces that with essentially 1 coin inside of the system equals 1 vote. And these two mechanisms are kind of similar because they both use economic resources to gatekeep what level of participation you can have in the network. And that's something which is necessary, because if you don't have that kind of economic gatekeeping, then one participant can just pretend to be a billion fake participants and then take over the entire network. And Proof of work does that. Proof of stake does that, in our opinion, better for a couple of reasons. One of them is that with proof of work, in order to prove that you actually have this computing power, you have to basically turn on these computers and have them solve mathematical puzzles 24/7, and this leads to a huge amount of energy consumption. And I think Bitcoin is at the point of exceeding probably the majority of the world's countries, and Ethereum is definitely not nearly at that point, but it's still much higher than I would like it to be. And proof of stake is much more efficient because instead of proving that you have computers by using them 24/7, to prove that you have coins, you just need to basically sign a digital signature with the same cryptographic key that has those coins. And so the network can run with much lower energy consumption, to the point where the main thing that you're wasting is just the fact that you have these 10,000 nodes that all need to verify every transaction, which is much less.
Mm-hmm. Interesting. Colin, you had a follow-up.
So yeah, I had a question on proof of stake. I think it's a really interesting idea. One of the things I'd like to understand is, do we have examples of where proof of stake, either in a blockchain system or outside of a blockchain system, has really worked so far, or is this all an experiment at this stage?
There have been simpler versions of proof of stake that have worked. So, for example, even back in 2011, there was a cryptocurrency called Purecoin that was released. There was something called NXT in 2013. Tezos is using proof of stake, and they did some kind of initial release fairly recently. There are a couple of others. It actually is fairly popular, but the kinds of versions of proof of stake that have been out so far are fairly simplistic, and the one that we plan on launching with is kind of much more powerful in a lot of ways.
So let's dive into that. What is the one you plan on launching, and how's it different from the simplistic ones that we would have expected to see?
Sure. So the simplistic versions of proof of stake basically replicate the structure of a proof of work blockchain. They just replace the randomness of the mathematical puzzles that people solve with computers with randomness that sort of gets virtually simulated inside of the blockchain. So you still have a structure where you get a block, and then a block on top of a block, then a block on top of a block, some time between blocks. And that kind of structure is nice because it's very simple and very low overhead, but it's also terrible because it takes a long time for blocks to come to consensus.
The eventual consistency.
Yeah, basically, in Bitcoin, for example, there's this idea of waiting for 6 confirmations, and that's an hour to confirm a transaction. And proof of stake chains that work in a similar way, basically inherit those weaknesses. Our approach to proof of stake combines together some of the insights from these older chain-based schools of proof of stake with Byzantine fault tolerance theory, which is a branch of mathematics that has existed for about 35 years that focuses on this question of, well, if you have some number of computers, then how do you get them to kind of quickly agree on data, even if some of those computers have been hacked or go offline or something happens to them. And now, that kind of consensus was originally designed in the context of a setting where you know ahead of time that these are the 15 people participating, and so you just give one of them a kind of participation token, and everyone knows who all the participants are.
Yes.
And that's why you can't just directly transplant that into a open public network setting, and that's why Satoshi went over to proof of work initially. But our idea is to take those algorithms and, first of all, kind of merge them together with proof of stake. And second, we came up with an algorithm that has some intermediate properties between the properties of these older BFT algorithms and chain-based proof of stake. So the problem with the older BFT algorithms is that they're designed for 15 computers, and so if you try to run them with 50,000 computers, you need extremely powerful computers that you basically, the only people who would run nodes are Google. So in our case, we have a version of this algorithm that takes longer to come to kind of final consensus, but still not too long. And even before it comes to final consensus, it kind of interweaves this BFT style of consensus together with a kind of chain-based style of consensus, but also not chain-based. And the benefit that this gives you is that within something like 5 seconds, you get a sort of soft agreement that this block is probably part of the history forever. And then in a couple of minutes, that soft agreement upgrades to a final finality and it's not going back.
Interesting. If any of you are familiar with the world of payments, with Visa, you get auths and settlement, right? When you go to make a payment, the thing that happens when you go to pay with your card is Visa says, oh yes, there's money in this account. The money doesn't actually move till a day later. That's actually similar, but what you're saying is it's happening on a much more compressed time frame for that network.
Yeah.
Interesting idea. All right, Colin, any further follow-ups on that point?
Follow up on that.
Yeah.
So one of the things that I thought was really interesting in discussion that I've heard over the last couple of months in the Ethereum community is a notion of economic abstraction. So being able to use multiple different kinds of coins or assets to pay fees rather than having to go through only Ether. Can that exist in a proof of stake or in a Casper type setup?
So proof of stake does inherently require there to be one enshrined or privileged currency in the network, because you need to have one currency that the proof of stake deposits are in.
Right.
And there are reasons why in some cases you might want to enshrine one particular cryptocurrency further. So one example of this is that there are benefits in some cases to having a model of transaction fees where instead of the miner deciding what to accept and you deciding how much to pay, there's some fixed fee that might be adjusted by some mechanism, but it's a fee that the protocol chooses and where the coins actually just get eaten up by the protocol. And if you want to do things like that, you need to have one particular currency that those fees are denominated in. That said, we definitely recognize the usefulness of economic abstraction as a thing that is good for usability and good for making applications more accessible and so forth. But I think there are many ways to achieve this goal. So more recently, we've been kind of bigger and bigger fans of this kind of layer 2 approach to design, where we make the base layer of a blockchain both reasonably simple, but also maximally general, so that if you want to build these more specific features on top, you can build them like basically as software libraries or systems of smart contracts that just sit on top of the blockchain.
Interesting. So that second layer gives you the space to be able to kind of do all of those abstractions in a completely different way, whilst the general layer underneath that's doing the kind of the general stuff.
Exactly.
It makes a lot of sense to me, and it kind of hints at those layer 2 things that we've been talking about historically. Those technologies, Plasma and Raiden are often brought up as potentials in that space, and we also get into sharding. Just walk me through what those technologies are and where they fit within that stack.
Sure. So sharding is a base layer upgrade. So it's an upgrade to the blockchain itself.
Yes, it's
and what sharding does is it changes the structure of the blockchain so that instead of every single computer in the network needing to download and verify literally all of the data that anyone sends, you break up the data into shards, so basically pieces, and some small random selection of nodes verify each individual piece of data. And the purpose of this is essentially that it allows you to still have the whole chain be verified, but at the same time do not require any individual node to process more than maybe 1/500th of the entire data that's being processed by the chain. And so you increase the scalability of the entire system by a factor of maybe something like 500.
But is there a trade-off there in terms of the overall security, or is that where is that trade-off?
There definitely are trade-offs, but the good news is that there's not any kind of trade-off that says security goes down by a factor of 500.
Right.
Like, there are more naive designs that people have thought of before where it actually is the case that if each node only needs to process 1/500 of the data, that means that if you break 1/500 of the network, you can break one of the chains. But the more recent designs use multiple layers of defense. Like one of them is a random sampling mechanism that basically means that if you are an attacker, you don't know ahead of time which nodes will have to verify what data, so you don't know which nodes to